Hey there, everybody. What if I told you that a single government bill could shift the US dollar, spike inflation, and also force the Fed to rethink interest rates and the plans that they have about that in the future? So that's exactly what the big, beautiful budget bill could typically do. So in today's video, I'm going to be breaking down what this bill is and how it affects the US economy, and also what traders like you and I need to keep an eye out on, especially when it comes to inflation, tariffs, interest rates. So, with all that being said, let's jump straight into today's video. So, I think the best place to start is to actually get a deeper understanding of what is the big, beautiful budget bill. And so, this bill is basically just a political phrase that refers to a large scale of federal spending, and it typically includes government investments, things like infrastructure, healthcare, defense, education, etc. And in simple terms, it's the government pumping money into the economy with the intention of growth, jobs in the public and private sectors, etc. And so it's just a means of stimulating the economy to a point where it ultimately grows. So here's the thing, okay? When government spends big, it puts more money into circulation. And this means that people have more to spend and businesses obviously has more to produce. And this pushes prices up, okay? So, yeah, sure, the bill does or could even cause inflation. And inflation is exactly what the Federal Reserve is watching very, very closely. Because if inflation starts running hot, the Fed may be forced to increase interest rates to cool things down. And obviously, higher interest rates usually means stronger dollar because investors chases higher returns. So, with that being said, there's another part of the bill that we need to examine. And in some versions of the bill, it also includes discussions on tariff measures. So, things like taxing imported goods to promote US manufacturing. And here's how things plays out. So, tariffs makes imports more expensive. And this typically drives prices up. Again, this obviously feeds into inflation. So they can also spark trade wars, which creates uncertainty in global markets, which is exactly what we've been seeing um, in the last couple of weeks. And this makes the US dollar very, very reactive and also very, very sensitive to these types of things. And it might also raise short term optimism, but fall if trade relations breaks down between countries that has trade agreements with one another. So the question now that we have to ask is how will the Fed typically respond in relation to this bill? What we have to understand is that the Fed's primary objective and its job is to balance growth and inflation. So when a massive bill like this comes and hits the economy, the Fed looks at the following things. Is inflation rising too fast? They'll hike rates. Um, and obviously, this makes the dollar stronger. And is the economy growing but staying stable? Then they might just hold rates as it is. They're also looking at is uh, is debt getting out of control or is growth slowing, which could result in a pause or even cut interest rates, which could result in a weaker dollar. So, in short, the bull's impact on inflation and the economic health of the US will typically guide the Fed as to what it needs to make an informed decision moving forward. And so there's a few things that we as traders need to focus on. So some of the things that we're going to be focusing a lot and keeping an eye out for is the following. inflation data, the Fed speeches and decisions, and also markets' reactions to government spending and tariffs, because these are all factors that can shift the dollar in a very, very powerful way. And if you're trading majors, then you definitely need to pay attention to these things in order for you to stay ahead of the curve. So, just kind of having a look over here on the calendar for this week, one of the things that we can see is that although Monday is going to be quite a quiet week, we do have Wednesday kind of kicking off with FOMC meetings. And these are going to be discussions between Fed officials that's going to kind of direct and steer us and give us some sort of clue as to what the Fed's decision is going to be moving forward in terms of interest rates. And so we also have jobless claims and the 30th bond auction. And then also next week, we do have a very, very active week, particularly pertaining to very, very strong inflationary indicators such as CPI and PPI that we are scheduled to see next week as well. So, with all that being said, if we go over here to the CME watch tool, as things stand at this very moment, there is a 95.3% probability that we're going to be seeing interest rates remain the same for the month of July. However, the moment we move over to September, we can see that it has a 66.2% chance that there's going to be a rate cut of 25 basis points. And this is going to affect markets quite significantly. So, with all that being said, if we jump over to the charts, one of the things that makes it very easy for us to kind of flesh this thing out is by starting off on the quarterly time frame. And the reason I want to jump over to the quarterly time frame is because we can see that for the dollar, last quarter did not close all that well. If anything, we had quite a strong sell-off in the dollar. And what this typically indicates is that we've come to test the bottom section of the ascending channel that we've drawn in over here, and just shy of testing the quarterly 50 period moving average. Now, if we scale over into our monthly time frame, we can now see that price is being supported by the 50 period moving average, but it's also being supported by the bottom, the third touch of the bottom section of the ascending channel that we have drawn in over here. And so the question that we're faced with is, will this be enough to see the dollar bounce off this area over here and kind of recover? And the likelihood of this happening is very, very minimal. And the reason for saying that is I do suspect that there's a potential that we could see a bounce at least towards the, I would say, 98.28 area over here, maybe a little higher, pushing it up to 98.65. Okay, that's as high as I will typically see the market possibly wanting to bounce. And the reason I'm saying that is because one of the things that we need to be cognizant of is September's potential rate cut, with the probability ever increasing towards that rate cut happening, ultimately leading to a weaker dollar down the line. And so one of the things that we have to contrast this with is actually how the S&P has been performing with it reaching all-time highs. And this is a very, very strong signal that we need to take from the markets in and of itself, which typically suggests that investors at this particular point in time are not necessarily looking to sell out of the dollar or sell out of the US. Instead, they are hedging, and this is seen in the S&P 500, the top 500 performing companies within the US in and of itself. And what you'll notice is that because we've seen all-time highs over here, it does show that there is still investor confidence within the US, be it the private sector, but there's still a substantial amount of confidence within the US in and of itself. And so we also go over to gold in and of itself over there, because gold is also seen as a safe haven. Okay. And notice that even though the dollar has kind of dropped so aggressively, gold has not necessarily been making its all-time highs that it did just a couple of months ago. And so there's a lot of stagnation that is surrounding gold. And this is also because of the fact that gold, there's not much need for it to be seen as a safe haven, especially with the ongoing wars between the Middle East, in the Middle East, subsiding quite significantly since it started with peace talks between Iran and Israel, and these are all things that influences how gold performs because it's seen as a safe haven. Now, it's not to say that this is the end of the run for gold because there is obviously other things, other factors that we need to account for. For example, the confidence that the reserve banks, the global reserve banks, has had in gold for the last 16 years, constantly buying and kind of reinforcing their own gold reserves also contributes and influences the price of gold as we see it continue make new highs in and of itself. So, with this being said, I think that we have to be very cognizant about how we need to position ourselves for the markets um, for this week. So, if I go over to the dollar and I kind of flesh out what we could potentially see happen to the dollar, the first thing that kind of attracts my attention from a technical perspective is the fact that we have a very clear bullish MACD divergence that occurs over here. And the market is in a very unique position in the sense that we have now seen a 95% probability that we're going to see rates stay the same, which means that the existing strength that the dollar has is likely going to continue into the month of July. And therefore, there's no reason for concern. However, we must also be mindful that if we just go back over here, we do have an FOMC that's scheduled to come out this week. On Wednesday, we see that there's an FOMC meeting where there's going to be a lot of uh, signals that traders are going to be listening out for to determine what they should expect and how they should position themselves moving forward. And so I'm definitely um, not opposed to seeing a short-term spike in the dollar, especially considering the fact that we are going to keep rates the same. We're likely to keep the rates the same in July. But in saying that, I don't see this as um, a complete reversal for the dollar to kind of completely recover because of what we are likely to expect in September or even October, depending on how the data comes out for CPI and PPI, which is also strong inflationary indicators that could also influence the Fed decision. So I would see that if the dollar is to gain strength, I could see that the first area that it might bounce towards from a resistance perspective is uh, 98.28. So I do see that this will be a viable area that the market could potentially revisit. I'm really stretching myself if I see 99 being tested, but from a quarterly perspective, I would much rather see a conservative 98, 98, 97, let's call it 99 uh, price level being hit, which does line up quite nicely with our daily 50 period moving average over here as well. So in the short term, if I'm going to see a bounce in the dollar, I can definitely justify or support my reasoning by just looking at the fundamentals that we're going to be, uh, you know, seeing over the next couple 2 weeks. And then scaling over into our lower time frames, one of the things that I would also like to see from the 4 hour at least is to see a confirmed break of our 50 period moving average over here. So if we can have price break and close definitively, convincingly above this 50 period moving average, then that is typically the last line of defense for the short term sellers to kind of allow short-term buyers to get into the market to potentially push the price up to 99. Okay, and that is a half decent run, especially if we're looking at the bigger scale of things. It's a half decent run on the shorter time frames, but barely a retracement on the larger time frames, but it does line up quite nicely with what we've discussed earlier. So this is just the take that I'm having. Like I mentioned to you, my bullish bias kicks in once we can see a confirmed break of the 4-hour 50 period moving average, so hopefully tomorrow, and this is going to determine whether or not we're going to see price starts to build momentum gradually, slowly towards its next area of resistance, which would be 99. So that is just the take that I have for the week ahead. Obviously, if price continues to scale, run to the downside and breaking the bottom section of the ascending channel, then we're obviously looking to move down. But one of the things that I'm also confident in is the fact that there are several bullish indications that we could see, like I said, a short-term bull run, a short-term bull spike. And this is, it might seem like a trend on the lower time frames, but it's nothing more than a retracement on the high time frames. And so this is what I'll be keeping an eye out for. And this bias only gets confirmed once, like I mentioned, we have that definitive, convincing 4-hour break of the 50 period moving average that could result in us starting to see the early parts of a short term run to the upside for the dollar, only to position us to see it further dip to the downside in the future, come closer to September. Obviously, this is sensitive towards the Fed's decision as we kind of head towards the end of July and we start evaluating and watching what does the CME Fed Watch tool tell us, and position ourselves accordingly. So guys, that is just the take that I have for this week's market prep. If you'd like me to kind of view other pairs, I'd be happy to do that. But for the most part, I do hope that there's some sort of insight, some sort of information, and some sort of value that you were able to take away from today's video. For the most part, if you have any questions, feel free to comment in the comment section below, and I will be happy to engage with you from that perspective. For the most part, I hope that you guys have an awesome day. Have a brilliant week, and I look forward to chatting to you all soon. Up until then, keep well, and bye for now.